A little over a year ago, I lost $33,000 trading Bitcoin and Ethereum. I was way over leveraged, I was chasing all my losses emotional trading, and the worst part of all is I was following these Twitter hype signals and these YouTube crypto experts telling me to go long or to go short. As a result, I lost 10 trades in a row and I almost gave up on crypto trading forever. But instead of quitting, what I decided to do was study over 200 plus profitable trades, and what I found shocked me. I found that they all had the same three confluences involved, and when I implemented these three confluences into my trading, my win rate spiked overnight. Today, I'm going to be going over my complete trading guide for 2026, the strategy that I will be using, and my favorite three confluences so that you guys can stop getting wrecked by the market and start making money with leverage trading. So tonight I'm going to be going over my full 2026 leverage trading strategy. This is the same strategy that I used all through this year, and I'm going to continue using it all through next year because it's what worked best for me. I like to call it the three confluence strategy. As the name suggests, there are three main confluences, and if our trade does not meet these three confluences, we will not be entering. So what we're going to need is our liquidation heat map and our exchange, which we'll trade on. I like to use Mexi, but there's so many other ones out there, what you use as preference. Also, a major thing I forgot to mention in the last video with Mexi is if you're an American and you'd like to use Mexi, you do need a VPN to sign up. But once you're all signed up and registered, you don't need a VPN anymore. It is just a one-time sign-up thing. I suggest Canadian or Mexican because those will give you the best connection on American servers. And if you're on PC, you can use Windscribe. It's a free VPN. And if you're on mobile, there's a ton of other free options. The three confluence strategy, we are looking for three main confluences. And as I said before, if our trade does not follow these three confluences, we will not be entering. So the first confluence we'll be using is called a liquidity sweep. What is liquidity? Liquidity is liquid cash that is in the market. So for example, if I were to put 1,000 margin or $1,000 into a trade or into an investment or whatever, if I put $1,000 into the market, that $1,000 is now liquidity. And here on our liquidation heat map, we can see, this is on Bitcoin, we can see all the areas where liquidation lies. So right now we're sitting about 87,700 to 88,000 on Bitcoin, and we can see there's heavy liquidity at 84,000, $86.9 million. A little bit ago, when we were below 85, we were kind of consolidating, not really moving. We had heavy liquidity, 24.9 million, 114.5 million, 74 million, and so on at this range right here at about 86. Liquidity is very important because the whales and big money need liquidity to fuel their own orders. So the market tends to follow liquidity and take it out as it sees fit. So as we can see here, we had heavy liquidity up here. We kind of consolidated, didn't move. Suddenly, volume pushed way up and we took all this liquidity out. So that would be our first confluence. A big liquidity sweep happened. We would see this and be like, okay, that's one confluence. Now, how else can we spot liquidity without using our heat map? It's simple. Liquidity is above the highs and below the lows. So if we look on here, we can see we had these highs and then we had a big liquidity sweep right here where we took out liquidity and then we immediately dumped after taking that liquidity out. Because price only moved so high and so fast because the whales, the big money, etc., they needed this liquidity. So they took it out and then price dumped back to where it was. So again, we would see this. We would see this big spike in volume, this big movement, liquidity sweep, and then this break of structure and change in market structure, and this move to the downside. So that is our first confluence, liquidity sweeps. It's very simple. Liquidity is above the highs and below the lows. If you need more help, there is this heat map that shows you where all the liquidity lies and it updates in real time. So you can see when liquidity is formed, when it's taken out, when a sweep happens, and that is your first confluence. All right, so the second confluence we are using is called a fair value gap. Now, a lot of people know the term fair value gap. They hear it all the time, but they don't really know what it means or how to use it. So let's pull up this app here and I'm going to show some Picasso drawings. In simple terms, a fair value gap is a 3 candlestick pattern where there is obviously going to be a gap. So we see there is a gap between the end of the first tail on the candlestick and the end of the last tail on the third candlestick. There's this gap here where price suddenly spiked up and left unfilled buy orders, which the market and the algorithm will look to fill. So what we're looking for off of this fair value gap is for price to come back down, take out this fair value gap, and then continue the uptrend. So if you go on the chart, let's find a fair value gap somewhere random on the chart. As we can see here, we have a very big fair value gap. Fair value gaps come in all shapes and sizes. It does not matter how big the middle candlestick is. All that matters is that there is a gap between the first candlestick and the last candlestick. So this is a bullish fair value gap, obviously, because the price went up. So for bullish, it is the top of the first candlestick and the bottom of the third. And here we have a bearish fair value gap where the bottom of the first and the top of the third, there's a gap in between them. So this fair value gap is interesting because this is what we call an inverse fair value gap, or an IFVG, where we have a fair value gap formed from here to here. We fill that fair value gap, but instead of respecting the fair value gap and continuing the uptrend, we disrespect it and we close below. So this is what we call an inverse fair value gap, and when this happens, this usually means our uptrend is over and we're forming a downtrend. Now, if we scroll a little farther, let's find another example of a fair value gap. So here we have another example. We have a gap between the top of the first candlestick and the bottom of the third candlestick. So we have this fair value gap here. Price on the next candle goes between, fills that fair value gap, and then continues the uptrend. So another example, let's find another one. Let's find a bearish fair value gap. So right here we have a bearish fair value gap. We have the bottom of the first candlestick and the top of the third candlestick. And as you can see, there is a gap in between. So as we can see, this fair value gap did not get filled for quite a while, but there's an important thing that goes on when this happens. So we see this fair value gap, we're expecting it to get filled, right? No. Another bearish fair value gap forms right here, where the bottom of this candlestick and the top of this candlestick has a gap. However, we can see that this fair value gap got filled. So when one fair value gap gets filled, so this bearish fair value gap got filled, we no longer care about this one. This one doesn't matter because another one already got filled. So we have a big fair value gap here, another one forms here, this one gets filled, this fair value gap is now invalid. We no longer care about this one. So now that this one gets filled, we expect the downtrend to continue and it to respect the pattern, but we end up closing above the fair value gap. So then our uptrend starts because our bearish fair value gap was not respected. So let's find another example. Here we have another bearish fair value gap. There is a space between the bottom of the first candlestick and the top of the third. Even though it is a very small space, it is still a space, and this is a fair value gap. So as you can see, this fair value gap gets filled, and again, we close above the fair value gap, forming a IFVG, inverse fair value gap, and this usually means that an uptrend is beginning, and as you can see, we pump higher, and so on. Let's find a couple more examples, and then we'll move on to our third confluence. Let's just scroll way back. And okay, here we have another big bearish fair value gap. We have our first candle, and then we have our second candle, big gap here. And now our third candle. As you can see, this is our fair value gap right here. Now, this one doesn't end up getting filled. Why? Because we see right here, 1, 2, 3. Here's the bottom of the first candle, and here's the top of the third. There's a gap here. This is another fair value gap, and this one ends up getting filled. It respects the pattern, and then it closes below. So this big fair value gap here no longer matters because this one below it got filled. So this one is now invalid. We forget about this. We no longer care about it. So the pattern gets respected. It dips lower. And then the break of structure occurs, and then we consolidate. Let's find another couple examples. Here's one. Here we have a bullish fair value gap where there is the top of the first candle and the bottom of the third candle have the space in between. As you can see, we do end up filling this fair value gap right here, and then we continue on. Here we have a bearish fair value gap. We have the bottom of the first candlestick. We have our big movement. Then we have the top of the third. There's a gap in between. We fill that gap, and then we respect the pattern, and we continue our downtrend. So our fair value gap forms. We, right on this candlestick, we push above here. We fill this gap, and our downtrend continues, as you can see, up until right about here where we have a break of structure. And that leads us into our third confluence, which I've already mentioned a couple times in this video, a break of structure. Now, what is a break of structure? Here we are again, returning to our Picasso level artwork. A break of structure is when we form, let's say we're in an uptrend, we're forming higher highs and higher lows. So this would be our HH, our higher high. This would be our HL. We're just going to say H, higher high, because it goes up. And then this would be our higher low, higher high, and then our higher low is right here. So let's say now we have our break of structure. This uptrend ends, and now we start forming a pattern that looks like this, where we have a lower high and a lower low, lower high, and a lower low. I know you can tell by this amazing artwork what we're seeing here. Basically, it is just we form our higher highs, blah, 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 uptrend, and then our higher lows. So then when this changes, when we stop forming our higher highs and our higher lows, and we start forming lower highs and lower lows, that's when we know that we have a break of structure. Basically, the structure of the market, whether it is an uptrend, downtrend, bullish, bearish, that breaks. So now if we head over to our chart, let's see, here we have an uptrend. Let's start from the bottom. We have, let's go on the 15. So here's our bottom. We form a higher high right here, and then we form a higher low, higher high, higher low, higher high, and this is active. This is right now, so we can't see where this goes, but here we have a great example of it again. Here's our bottom. We have a higher high right here, higher low, higher high, higher low, higher high, higher low, higher highs, higher lows, higher highs, higher lows, lower high because we didn't break above this. So lower high, lower low, a lower high again. As you can see, our high where we peak is going down. Lower low, lower high again, lower low. So now we're in a downtrend. This is a bearish movement. We keep forming lower highs and lower lows. Then eventually we get here. We form a higher high, higher low. Because this low closed above our last previous low. And then we have a higher high again. Then a higher low where we bottom out. And then a higher high, higher low. Higher high, and then that's where we are now. So break of structure, look for higher highs, higher lows, or lower highs, lower lows, and whichever pattern breaks, that is your break of structure. So one more time, let's just scroll through. Here we see an uptrend. We see our bottom. We form higher high, higher low, higher high, higher low, higher highs, higher lows, higher high, and then we have our break of structure right here. We could start forming lower lows and then lower highs, lower lows, break of structure, higher highs, higher lows, higher highs, and so on. So now that we have our three confluences, 1, liquidity sweep, 2, FVG for value gaps, and IFVG, inverse for value gaps, and 3, BOS. So now that we have our three confluences that we need for our 3 confluence leverage trading strategy, now we can start looking for trades. So let's go on our chart. Let's go on the 15-minute. I like to use the 15-minute. I think it's easiest to read. Let's see. Right here, we have our liquidity sweep. We have our break of structure, where we start forming our lower lows, lower highs, and then we have a fair value gap right between here and here. So all three confluences got hit. We get short around this range, and as you can see, it goes down from here. Our short would be a win. Now let's scroll to another random point in time. Let's find our liquidity sweeps right here. So we have a downtrend. As you can see, we have previous lows around here. We take out these lows right here. We have our liquidity sweep. We have a break of structure because we were in a downtrend before, and now we're forming higher highs, higher lows, higher highs, and so on. And then we have a fair value gap. We have fair value gap here. We have fair value gap here. We actually create a bearish fair value gap, and we fill this fair value gap, and then we disrespect the pattern. So what you'd expect to happen is we fill this fair value gap, and then price continues to decrease. But since we closed above this fair value gap, that means we disrespect the pattern, and we will continue this uptrend. So now we have all three confluences. We have liquidity sweep, we have break of structure with our higher highs, higher lows, higher highs, higher lows, and we inversed our fair value gap, which means we closed above this bearish fair value gap, which means that we will switch to an uptrend. So all three confluences could get filled. You could get long, you could enter long once you get your confirmations right around here, and that would be another big win. Wow, you could hold that for a while. Yeah, that would be a big win. You could hold that from 84 all the way to 93. Wow. Even on a low leverage, like 10x, 15x, that'd be a huge win. So let's find a couple more examples, and then we'll summarize this and wrap this up. Here we have a liquidity sweep. We have a break of structure. We go from bullish movement to bearish movement. We form lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So we have our liquidity sweep, our break of structure, and do we have a fair value gap in here? Let's see. We do. So there's a fair value gap here. We fill it, we continue up, and then we don't form another one. So this we would not enter because it fills 2 out of 3 confluences. We don't have another fair value gap to base this off of. So let's continue looking. Here we have a liquidity sweep. So right here, we have a big liquidity sweep. We have movement here. We spike all the way down. We grab liquidity, and then we recover. We form a fair value gap between the bottom of the first and the top of the third. We fill the fair value gap, and we continue our bearish or our downward movement. And then we form another fair value gap right here between the bottom of this one and the top of this one. We fill this one, and we continue downward. And then from there, we have our break of structure. We form higher highs, our higher lows, higher highs, higher lows. So we have our liquidity sweep. We have our break of structure, and as you can see here, we have another fair value gap, which we fill, and then we close above. So we inverse this fair value gap. So right here, all 3 confluences are met. As you can see, you could enter your long right around this range once you get that 3rd confirmation, and that trade would be another big win. So as you can see, all those trades we went by with this strategy would have been a win. You wait for all 3 confluences, and then you enter, and then you have your stop losses, your take profits, depending on your leverage. I usually like to use 10 to 20x because it's safer and you can control it more. And on these trades and with this confluence setup, you can get some pretty big wins off of it. All right, so in conclusion, we went over the 3 confluence leverage trading strategy that I will be using through 2026 and what I use through 2025. We went over break of structure, liquidity sweeps, and fair value gaps and inverse fair value gaps and how to use them. If you have any more questions, leave them in the comments below. And sometimes in the future, I will be making a in-depth video on how to use these confluences and what they really are down to the roots. But I hope this video helps and you guys can use this in your trading. And it's 3:14 a.m. and I have a flight to catch, so I'm taking my ass to bed. Good night.